How are you out there? Enzo DiCosenzo podcast, and let's continue with the plant assets and depreciation methodologies from last video. Okay, folks. So here we are with this. This is Iron Mountain Ski Corporation. There is some sort of equipment that was purchased for $50,000, and the salvage value $2,000. Useful life 10 years, and we don't have the mileage thing. Okay. The depreciable cost obviously is going to be the difference, 1,000 minus the 2,000. The annual expense would be the 48,000 divided by the 10 years. Okay. And the rate would just be the ratio, which obviously is going to be about 10%. Okay, whoops. What we wanted. Okay. All right, so this is just a repeat of the straight line version of things. Again, we're just repeating ourselves here. We'll start with 2012, and we'll add another year. $48,000. That's what you're depreciating. Okay. We're just bringing it from there. And it's the same, that's that same number every year, right? It's that same number. Like that, right? And again, the rate would be the same rate every year, 10%. Okay. And the expense again, these this is a nice version because this is just very clean. Everything here is just very clean. All right. So the first, 5 columns, including the little index here, these are all just very clean numbers. And here with the, like I said, with the accumulated, we could do that sort of summation thing, or we could just do this, set that equal. Right? And then you can say the previous accumulation plus the annual depreciation expense, right? And then just do it the whole way down until what you're, you get to what you're depreciating. So you're depreciating 48,000. That's what you're depreciating, and we just did it, right? So all these are. This is just this. It's the accumulated depreciation from the line above, plus the current year's expense, and it's the same. So it will be 2013's accumulated depreciation, which is 96, plus another 4,800, which gives you 14,400. So this is what you're trying to get to, and you just got there with that. So that we have. The book is what you started with minus yeah, the accumulated. We can do it like that. See how we're working this? So you're taking what you're doing. I mean, there's a couple ways you could do it, but we're taking that initial book value, which is the 50,000, and then subtract out the accumulated every year until you get all the way to the bottom. That's the salvage that we're looking for. And the percent depreciated is just, for the straight line, you can just go all the way down until you get to 100%. So here, the tougher formulas, these are all just referrals to other cells, right? This is just the 48 from up here that we figured out, the 10% from up here, it's just these three, put in a table. The accumulated, again, it's a previous accumulated number plus the current year's expense, and the book is you're subtracting out the accumulated depreciation relative to that initial book value, which is the 50,000. That's 50,000, and then you'll write it down to 2,000, and then what you do down here, this is just for the first year. The expense is the 2012 number, and you're going to credit out this other one. So what you're doing, you're recognizing under equity debit, which is a plus, and then a negative out front, which makes it negative. And then accumulated depreciation is on the asset side, but it's a credit. So the two negatives, that's a negative 48, because on the credit side, the negative 48 for expense and the negative 48 for accumulated depreciation match up. Okay, that's all this was. This was just an example of that. Down here, and I explained this live in class, this is taking everything that you did, all of your methods that you worked on, and just sort of, compressing it into one space. Is all you're really doing here. Okay. You're going to underline this, and you say equals sum. Which is all right there. So. Okay. That's the 5 years of payments under straight line. Then you're going to go to units of activity. You're going to observe those. These were a little more scattered, right? Recall that? These were a little more scattered, which was this. Again, the same amount depreciated, right? It's 12,000. You're depreciating 12,000. I'm just bringing over the formatting with this one. Now we're going to find declining balance, which was here. And there, you barely got your 12,000 again. With this funny one down here, remember how we had to move this down a bit to the 685, so we get the 12,000. So what you've done is what we spent, now in the live class, it was a bunch of classes, but here it was, 3 different methods of computing depreciation is what this was, and we condensed it and compressed it into just this little box, if you want to call it that, right? And that's, you want to get used to doing things like that, where you might do a lot of work on something, and then boom, you have a short sort of summary that you're given to the senior people about this. The other thing, so this is a table. Okay, the other thing we like to do with things like this is we like to create a graph of it. So see what says charts, and the scatter with the straight lines and markers. See how this looks? Okay, and actually what we could do, we can just sort of move it over a bit. Like that. And this is depreciation methods. Okay. So this is that first line. Right click, select data, edit. This is straight line. Marker option, built in, and you can make it a bit smaller like that. Okay. And you can do a couple things. You can click on this and go to design and go to select data. Oh, no, wait. You want to go to legend. All right, legend, the legend up top, straight line. See that? Obviously, this is that 2400. Okay. Also, you want to do chart title. We have axis title, horizontal, vertical. Okay. And this would be what? This would be years. This is depreciation expense US dollars. Okay. And actually, I think what we did here, we didn't use we don't really need the grid lines for this. So what you can do, you could right click, format the area. We're looking for shadow. Go to the first shadow version of this. Okay. So it gives a little bit of a shadow effect. We like that. Format the grid lines, no line. The grid lines, no line again. The vertical is no line also. Okay. And I think with the border here, let's go to a nice medium gray or something like that. Yeah. There you go. Like the third or fourth one down, it's about the same. All right. And you could play with this is sort of a charcoal gray. If you want to make this the font maybe a deeper color, you could do a blue or something like that, right? You could do that. You can outline the whole graphic here. You can change and actually here, but the font, we always like a little bit of a smaller font, even like an 8 or something, because you don't need the axes to pop so much. So right there. Well, right click, select data, add the same year's units of activity, and this is units of format the series. You want the line, or no, I'm sorry, you want the marker option built in. Okay. And you want to fill this with a very light gray, a very light gray. See that? See how good that looks? And these you could do font, the color. See, it's a charcoal. You might want a black. Something like that. Okay. I have something. I have like an example here. This is an example from whenever that was. Old. Gold. Again, that's sort of a grayish, not so much of a black. And there's a third one, declining balance. Select the data, add. Again, same thing. The 5 years, the declining balance column. Hit OK. Hit OK. I don't love this gray, so let's do some other color with this thing. Let's do, I don't know, maybe a green. How's that? Right? That's not too bad. Marker, format the data series, built in for. Okay. We call it depreciation methods or patterns of depreciation, whichever. This is, I made this graph previously. I don't know why it's a little more spaced out than this one is. Is it 2 years? No, it's still one. It's still a 1 year. Yeah. Oh, I don't know why there's two. We broke this up into two. So format the axis. You want a year like that. There you go. You don't want, yeah, you don't want these to be twice. They did like the half year version of everything. This is at the end of each of these years, is all we care about. Okay. That's how you make a graph. Learn how to make graphs. Okay. So you got that. Depreciation taxes. Yeah. This is going back to the SEC discussion, preparing financial statements and preparing your records for tax computation. You're it's the same company, but those final numbers could be different. You could have a lower earnings because you want to pay less taxes, right? That kind of a thing. So keep that in mind, and certainly with especially if you're a publicly listed company, you're going to want to have a higher earning to have a higher share price. All right, so you have that. Okay, but that's pretty much. And there's accelerated cost recovery systems, and different whatever the IRS says you can use to depreciate your straight line is most of them, but there could be some a little more exotic versions. If you get approval to do it, then you can present it. I'm sure you want to ask the IRS and a tax attorney and KPMG. You want to ask all those companies how to do all that and what is allowed and what's not allowed. But it's a use of estimation in the accounting process. That's what depreciation basically is. Uh, and here's something else that can sort of happen here. We would never go back in time and restate, because anytime you're and I've there's a company that we're in the process of maybe acquiring, at least studying it to be acquired, and it restated its numbers, and it makes you pause and say, well, why did that happen? And makes you go back in time and figure out, that's not those aren't great questions to ask when you're trying to sell the company. So uh this is the truck problem. And again, I almost have to apologize in a sense. Obviously, what truck are you gonna buy for 13,000? As I was driving today, I saw some PSC&G vans that I'm sure are 50,000 or more, easily more than 50,000. So this is quite a long time ago. But these are the same numbers from up top: the 1,000 salvage and the 13,000 cost. This is the 5 years and the 100,000 mileage. And then you have this maneuver, right? You compute the depreciable cost. It's 12,000. The annual expense is just that 12,000 divided by the 5 years. And then the rate is simply that 2,400 divided by what you're depreciating. And what happens is there's two changes. Instead of 5 years, the useful life is going to be 6 years, and the salvage value increases by about 120%, or 1.2 times. Okay, to 2,200. So you're gonna, and this is after. I think this is after the third year. This all happens. I don't know where it says that, but computer depreciation over time revision. So I'm sure somewhere, obviously, obviously we're working this as if that's what the I'm sure it says it in the textbook. So after the 3rd year, yeah, here it is. Because you're right. So it decides on the first of 2015. So old 12, 13, and 14. Yeah. So you have to, it doesn't say 3 years, but it says it here. It says to illustrate, assume the flower shop decides 3 years in, so January 1st, 2015, because you theoretically started everything January 1st, 2012. So 2012, 13, and 14. So you have the other 3 years to work on. So what you do is the first thing that you would fill out in terms of your table, you'd fill out the initial depreciable cost, which was 12,000. And this is the same thing, and this is the same thing. The rate would be 20%. That's 2,400. But again, if you make that decision on the first of this next year, it's a whole new set of uh, of a depreciation table. You extended it one more year. Now it's 6 years instead of 5, and you have a new salvage value. Okay. So the initial depreciation is at 2,400, and then you have the previous one plus the next 2,400, and there, old age and right. So obviously, so it's 2,400 times 3 is the 7,200, and the book is going to be that 13,000 minus the accumulated every year. So the book sunk from 13,000 to 5,800. Okay. So that's what you, so you, what you're going to do is you're going to start depreciating. Yeah, 58. So you're going to start depreciating from 58 minus 22. That's your new depreciable cost. And the percentages depreciated are this thing. If six, yeah, okay, yeah, but 60% depreciated. But the next piece of this is the revised. It's not that 13,000 anymore. Well, here you can start with the 13,000. The new book at that particular date is 58, and the salvage is 2,200, which is there. We have 3 more years. Yeah, 15, 16, and 17 are 3 more years. Don't worry about miles. So now what we're depreciating parenthesis the book minus 2,200. That's what you're depreciating, and the expense would be equal to this divided by 3 years, and the rate would be 30 something. Okay, 33%. That's another revision that we're going to get to in a bit. Okay. So now the new depreciable cost is 3,600. The new percentage is 33. All right, that's new percentage is 33. And the annual expense would be now it's 1,200 as opposed to 24 because it's less years, right? And this would be equal to that 72 plus the 1,200. 84 plus the 1,200 again. And this is just Control D. And somehow, what do we do with this thing? This is just at 13,000 minus the new salvage. So the total depreciation has to be 10,000, and it is. So we checked it. This is just a check. Okay, we computed this, that 10,800, we computed just from our table. Okay, the book on this, the book on this is simply that's 4,600 is the book. 3,400 is the book, and obviously you want this to get to 22. So this is whoops. So we'll say copy Alt H formula. Okay. So you took your 13,000 right up here and minus all all the cumulative depreciation, which got you to 22, which is what you're searching for, right? That's the 22, which is right there. And these are just percentages. So this is just paste formula out. Okay, and this is going to be that's the 13. We could do in a couple. That's probably the 58, right? It's really probably the 58. Is it the 58? No, it's not that. What is that? That's the 13. That's the 13 is what that is. There's your 77. Okay. See what that is? This is the accumulated divided by the new depreciable cost. These are the depreciable costs relative to the 12,000. Right now it's the depreciable cost of 13 minus 2,200. All right, because you're only trying to get down to 10,800 is what you're trying to do. Yeah, 11. Yeah, 10,000 because the two. Yeah, you're trying to get to 10,800. Okay. 13 minus 22, and then the accumulated is in the numerator. But there you go. So you have a revision now, which so again, going back and this, and the question always comes up is, why are you doing this? Right? That's always a question that's going to come up. There's another one of these sitting here. This is just a repeat. Okay, so we're going to come back to this one because we're not going to finish. Yeah, we're not going to finish this whole video today. But what I do want to spend just a few, what's remaining left of the time here, do a little bit with plan asset disposals. I think this might be a good spot. right there. Okay. Let's go. Let's do about 150 lines. This again, disposing of assets is important. This comes up in total comprehensive income and analyzing a bank, anything that disposes of an asset or financial instrument. You want to figure out the gains and losses and how that's impacting that company's valuation. So, but the idea behind this particular discussion would be when you're disposing of plant assets that are no longer useful, there's disposal methods. The company must determine the book value of the plant asset at the disposal date to determine the gain or loss. The book value is the difference between the cost of the plant asset and the cumulative depreciation to date. That's what the book value is. If the disposal occurs at any time during the year, the company must record the depreciation for the fraction of the year of the date of the disposal. So again, everything doesn't happen on January 1st or December 30th. Okay, it happens all throughout the year, and you got to prorate things when you're doing this for real. You have to be able to prorate. The company then eliminates the book value by reducing or debiting the cumulative depreciation for the total depreciation associated with the assets at the date of disposal and reducing the credit or crediting the asset account for the cost of the asset. Okay, that's I just ran through that, but you guys have that on the you guys have that on your Excel files, and it's here. You guys can just easily read this. Sale, retirement, exchange. Okay, there's a couple methods of asset disposals. So, retirement of plant assets. So, I always think back to Warren Buffett, and it was a cotton weaving company. Berkshire Hathaway was a cotton weaving company up in New England, and Buffett loved the New England work ethic, and the people worked hard, and took life seriously, and all these other kinds of things. Were religious, and on and on. And the looms. And it was the company made the line. Now again, women who wear suit jackets might be aware of this, but with men certainly it's a big deal. A man's suit jacket has an inner lining, or at least it should have an inner lining, and you can have all sorts of colors. The suit could be blue or dark or gray or whatever the suit color is, but the lining can be any color. So I have some wine colored paisley wine colored linings. I have some blue, a nice color blue. You can have your name if you have the suits made. You can have your name embroidered in there somewhere, or anything, and some funny ones too. I think some can be, I don't know, pictures of whatever, a house or whatever it might be, but just something. It could be something silly. I remember one of the first leather jackets I bought. It had like little European towns, like almost like a Christmas scene on the inside of the leather jacket. I bought the jacket, God knows when, and I don't think I barely even wore the jacket. It was a brown leather jacket. I have to go digging in the closet. I think it had no collar, which I don't like jackets like that don't have collars. But anyway, the inside was a lining, and generally they're made out of cotton. So linens for hotels and things of that nature. There was a big business for that, but obviously, as push came to shove, it became less appealing, less profitable to operate a cotton weaving company that makes material in Boston or in Connecticut or something like that, or in the northeast part of the country. That became less appealing. I don't know where the book I read Warren Buffett's life up to like 1995, and it said what happened to that industry. But I don't. Sitting here, I don't recall what happened to it. But I'm sure it went to just cheaper places where the labor was cheaper. So anyhow, so if there's it says retires computer printers, fine. So there's some sort of electronic equipment that cost 32,000, and the accumulated depreciation was 32,000. Okay. Folks, little by little, we're fixing all these extraneous zeros I don't know what I was thinking when I was doing this, but we have all these extra zeros. So guys, give me a second as I'm sort of cleaning them up a minute. You can't do it if you try to do them all at once. All the formatting will be the exact same it'll all be the same, either black font or whatever. You may not want that. So I'm trying to be careful not to change all the formatting. So that's why it's a little tedious. But as we're sort of going through everything, I'm just trying to clean these up a little bit. There you go. Little by little, we'll get these all cleaned up. So a little tedious, but we're almost finished with this. I'm just doing a little at a time. So okay, good. Okay, so what are we doing here? So this one's pretty straightforward. So what does it say? It says accumulated is 32,000. So an accumulated is a contra asset. So if you dispose of it, that's how that's how you record that. It says 32,000, so it's fully depreciated, so it's zero book value, and you're writing off the equipment because you don't have it anymore. Okay, and that's how. So in other words, so you write off the depreciation. You don't recognize the depreciation anymore, and you don't recognize the equipment anymore. This is retirement of equipment, so it's a fully depreciated piece of equipment. You write off the equipment you don't possess anymore, and you also don't worry about the accumulated depreciation. So you write the both. So you're basically, if let's say if this is a company that owned that one piece of equipment, you've zeroed those accounts. Is what you've done. Right, remove from the all the small amounts related to the asset, original cost, right, on. Okay. Then it gets a little more complicated. If the company retires before it's fully depreciated, no cash is received for their scrap or salvage value. Loss and disposal occurs. So Sunset Company discards delivery equipment that costs 18,000. It accumulated to 14,000 of depreciations. There technically there's 4,000 left, but I suspect that's what the loss is going to be. Yeah. Okay. So what you're doing is so you're writing off the 14,000 in equipment, right? Um, the equipment costs 18,000. That's what it cost. So obviously you're going to write that off. But also, and I hate to say sit here and do it in your head, but if the equipment costs 18,000 and the accumulated depreciation is 14,000 and you're selling it for nothing, you can just do that. It's very obvious that it's that you have that 4,000 loss. So you sum these, and that's your whole equipment write off is 18,000, which is right there. Okay, that's how you balance all that. So you're writing off an $18,000 piece of equipment that you've only depreciated up to 14,000, and then you got nothing for it, so it's a $4,000 loss. Balance on all that. So so under equity, right? It's obviously that's going to be debit, which is going to be negative. That's your loss under equity. This is going to be under assets, negative. This is going to be contra assets. So the debit is plus. So the 14 there and the 18 there, it's positive 4,000. And no, it's 14 there. Yeah, it's negative 4,000. This is also negative because it's debit, but it's under equity, which is negative. Negative 4,000, then negative 4,000 here because it's 14 minus 18,000. Okay. Another one of these. This is a gain. So the furniture cost 60,000. You sold it for 16. The accumulated depreciation was 41. And for the first 6 months, it's another 8,000. Okay. So how do you record all that? Is what you're looking at here. So the first thing you want to do is record that 8,000 worth of depreciation for the first half of the year. So this is for the first 6 months. You record that. So in other words, you had 41. And well, actually, the furniture cost 60. Yeah, the original cost was 60,000. And the accumulated was 49. And how do you do that? Well, it says 41 here. How do we do it? There and yeah, I mean we can just add it, but what you can do also is the following. You can do that just to have the number sort of there. And this other 8, I mean, you typed it in here, but you could put, you could do the same thing over there. You could have done that. So this is 60, and this equals negative parenthesis. This is your 8,000 plus the other accumulated, which is 41. Okay. So the book at the sum is 11,000. Okay, the proceeds are 16. So the gain would be the 16 minus that 11,000. And again, you also have to know what you're computing. So they say, oh, well, did the math tell us that? Well, it did, because if the proceeds from the sale are 16,000, the book is 11. You're selling something that you're holding on your balance sheet at 11. You're selling it for 5,000 more. So that's a gain. So we did all of that. Okay, we did all that. So you received, I mean, you could equate this. You could say equals 16,000. You could do it like that, right? You can do it like that. Accumulated equals the negative of the 40. I mean, well, or you could just recompute them. You can just do, what do we have? 41 plus 8. That's accumulated. And this is 60,000. There. And the gain is 5. And we did a little check down here. Right, you said equals sum. All right. So you wrote off the equipment. You received 16,000 cash. Your contra asset 49,000. You sort of again this for that's like you're writing off the cumulative depreciation. You're writing this off your asset. You're writing this off your contra asset. Okay. So you have 11 here. The net's 11, and you're bringing in 16. So the gain's got to be 5. So this 5 balances the extra 5 here from the cash side. So in other words, you're netting. See, on the asset side, you're going to net out these two. So that's going to give you 11, right? That's going to give you 11. So yeah, that's going to give you 11. So there's 11,000 there, and then you have the 16. So the 5, right? The 5 is the credit, and 16 minus the 11, because this is on this side. See, when this is a credit on the asset side, that 11,000. So it's 16,000 minus 11,000 is 5,000. That balances the 5,000 on the equity side, which is positive on the right hand side of the accounting equation. Okay, so that's how that balances. And the last thing we're going to talk about. So this is other revenues and gains. This is something, it says instead of selling the furniture for 16, you sold it for 9. So this is the same problem. So this is doing it for a loss. Okay, this is doing it for a loss is really what this is doing. So cost here would be 60. That'd be 60,000. The accumulated would be those two again. So copy. Right, there's your 49. There's your 11. The book value at the disposal is 11. The proceeds from the sale are 9,000 this time. And this is going to be equal to, you're bringing in 9, but it's on an 11,000 book value asset. So that's why it's a 2,000 loss. And you could do it, and wow, I mean, you could do it like that, or you could just do it like this. It's a loss. So the cash on this is 9,000. And the equipment is 60. And the accumulated is 49, right? And the loss is going to be on the left-hand side. Okay, so to make this balance, we're at 58,000, so you're gonna need another 2. You'll need this 2 in there. And there you go. Okay, that's how you recognize a loss. You had a loss example, you have a gain example. So obviously the gain is on the credit side, the loss is on the debit side. So looking at this again, that 2,000 is on the debit side of the equity account, so that's a negative. And so on the asset side, you got the cash coming in, you're netting out your depreciation. So this is going to be 11. Yeah, so it'll be a minus $2,000 credit on the asset side, and then a minus $2,000 debit equity, but it's negative on the owner's equity side on the other side. So it balances. The minus 2,000 is balance. Okay. And we'll have a part 3 for this. Okay, if you guys just stand by a minute here. Straight line compare, revising period depreciation, and then we did so this will be 3, will be the next one, right? And so we did revising period depreciation, comparison of methods. We'll do plant asset disposals. There's plant asset disposals. We're not going to do any of these. So what we'll do revising, we'll do and continue. This is continued. We have a natural resources example. Okay. And we'll pick this up again. Then we have intangibles that we're going to look at. So we have a lot of stuff. All right, folks. Thank you very much. And we'll see you soon. Thank you. All right, folks. Thank you.